Hi everyone, my name's Darryl Panes, CEO of As Good as Gold Australia, and today once again I'm joined by my brother Brian.
Thank you, Darryl.
And partner at As Good as Gold. And today we interview Chief Economist John Adams. Good morning, John.
Good morning, Darryl and Brian. How are you going today?
Very, very well, thank you.
Thank you, John.
And I'd suggest that gold and silver are doing very well at the moment too. Gold up around 25 Aussie last night as we speak, and silver currently just under $1.
Yep.
Up just under $1. So maybe we're seeing an advancement here. Let's say we may be seeing gold and silver surge again. That'd be great, wouldn't it? It's about time.
It certainly is about time, because we know it's been $3 more than what it is now. And it's only the powers that be that have tracked it down or pushed it down. So it can only go down so far before people start jumping in and start buying again. And the whole problem there is, of course, is the delivery aspect of the physical. You know, the refiners around the world get inundated with orders. And it's not a week delivery, but 4 weeks, 6 weeks, 8 weeks delivery, maybe sometimes 12. So the answer is don't wait. Just continue to buy.
Well, silver up. Now we're going to talk about bonds.
We are going to talk about bonds today.
The bond market seems to be on tip of everyone's tongue at the moment. So the bond market, John, the bond market around the world has been in turmoil over the last two and a half weeks. What I'd like you to do, if you could, please, is inform the audience as to what's happened in the global bond markets and what's caused the current turmoil and what are the implications.
So when we look at, say, the last, 6 months, bond yields, so the interest rates on the bonds, have been going up around the world. And what does that mean is, so just so our audience understands, there's an inverse relationship between bond prices and the interest rates on the bond. So as bond interest rates go up, that means that the bond prices are going down, which means that people are selling bonds. Now, why have bonds being sold off is because there's a concern that inflation is going to be picking up. And we'll get into the inflation story soon. So, but the key narrative from 2020 was that we locked down the economy because of COVID-19. We injected the biggest amount of stimulus in the history of economics, particularly in the Australian context, in terms of fiscal and monetary stimulus. And now that, and a lot of that, particularly the fiscal stimulus, was saved by households. They either saved it or they paid down debt. The theory now goes is as we roll out the vaccine, as the economy opens up, people are going to start to spend a lot more money, and that's going to generate a lot of inflation. And that's what the bond market is concerned about. And so the reason why people who own bonds are concerned about inflation is that as inflation goes higher, the real value of bonds, the real rate of return, that goes down. And that means that in real terms, people make less money. And that's why they've been shifting out of bonds and going into real assets, particularly commodities. So that's the 6 month backdrop. Now, what happened that really triggered off concerns in the last 2.5 weeks is these, particularly under the Biden administration, which has just been in power for a month and a half, their policy announcements has spooked the markets. 1.9 trillion in COVID-19 relief stimulus, which has just passed Congress, an extra 2 trillion in terms of climate change over 4 years. A whole bunch of regulations, which has been detrimental so far to the U.S. economy. That has concerned the markets as well. And then on the 25th of February, in particular, there was a bond auction in America for 7-year government bonds, and it was the weakest result on record. So domestic demand for the bonds was way down, and foreigners in particular. So foreigners have been a big reliance or a big source of capital for the US government to fund these deficits. And on that occasion, on the 25th of February, the foreigners have said, thanks, but no thanks. We don't want to buy these bonds at these particular interest rates. And so they still raised all the money that they wanted, but because not enough people showed up to the auction as per usual, that caused a big stir in the bond market. And then that started to ripple through right across the world, including the Australian bond market, Japan, Germany, etc. So basically, we saw interest rates start to spike quite a bit. In the US, interest rates got up to 1.6% on the 10-year bond, in the Australian context. So Australia so on the 3-year bond, we have what is called yield curve control. So what some of our audience may have heard about this term. So this was implemented starting in March of last year, where the Reserve Bank of Australia targets the 3-year bond rate. So they announced that they were going to target it at 0.25 last March. And then in November, they said they were going to reduce that target to 0.1. And the 3-year bond rate for Australia is important because that's what the banks use to determine their funding. But also the 10-year bond rate was going up. So the RBA was struggling to keep this 3-year bond rate at the 0.1%, and the 10-year was going out of control. And so we've seen so far in the last 2.5 weeks, central banks intervene in the market. So last Monday of last week, the RBA announced at the beginning of trade that they were increasing their daily bond buying program from 2 billion a day to 4 billion a day. Then they came out on Tuesday with the RBA board meeting, and they said that they were going to effectively maintain their current policy set until 2024. Now, on quantitative easing, last year they announced $100 billion in QE. Then at the beginning of February, they said that once the initial 100 billion is exhausted, they're going to do another 100 billion. And then they announced last week as well, once the second 100 billion is exhausted, we're going to do a third round of QE. So they're pretty much saying that markets and the bond traders shouldn't be concerned about the commitment of the central banks. If they need to step in and just buy these bonds to keep these interest rates under control, that is what they are going to do, and that provided some reassurance. Now, in the US context, that reassurance hasn't been provided yet. There's a lot of concern about, so the market and the Wall Street is expecting some more stimulus, more support from Jerome Powell and the US Federal Reserve. That hasn't happened. Now, 2 big events coming up. One is this week, we've got another bond auction coming up in a couple of days. This is for 10-year bonds in the US. And if it's another bad result for the bond market, that could cause another round of turmoil right around the financial markets around the world. And then next week, we have the US Federal Reserve with their March meeting, the FOMC, and everyone will be expecting some sort of additional announcement, whether it's additional QE or yield curve control coming next week. So, we'll have to see what happens. But the reason why this bond market issue has been such a concern is, as interest rates on the bonds go up, that means that if you own, so particularly the US 10-year bond, the interest rate on that bond is a benchmark that is used to price debt around the world. And as interest rates go up, that means that interest service costs go up. And because we have the biggest debt bubble in the history of the world, that means that repayments on the debt go up. And if interest rates continue to go up out of control, at some point, someone will say, I can no longer pay these debt repayments. Then you're going to start to see delinquencies. You're going to start to see defaults. And then if you start to see a big institution, a bank, a government, like a household sector, etc., say that we're defaulting, that could then lead to a huge deflationary depression, similar to what happened in, say, 1929 or what happened in the global financial crisis in terms of 2008. So, one of the key points that I've been making over the last week is that since 2008, we've had a number of crisis points, whether it's the Greek sovereign debt crisis in, say, 2012, or the repo market blowing up in 2019, or COVID-19 blowing up in March of 2020, or now in March of 2021, the bond market blowing up. And every time there's been a crisis point, rather than allowing the debt market to blow up and have a deflationary depression, they continue to inject ever more stimulus to keep the show on the road. And the consequence of that is that more inflation, more debt, and dare I say, given that they have doubled down every single opportunity in the last 13 years, I don't think they're going to let this let the debt bubble go. So I think I'm expecting more stimulus announcements going forward, and that's all. The consequence of that is that it's going to just add fuel to the fire of the stagflation process that I've been talking about over the last 9 months.
I think you're right. As you know, John, going back just a few days ago now, we interviewed Jim Rickards, and Jim has titled his new book, The New Great Depression. And we all know, of course, that the Great Depression followed the Roaring Twenties. And I was sitting there last night and just thinking about this. And I'm thinking, right now, I think what we could call the period right now is the new Roaring Twenties. And what's going to follow the new Roaring Twenties? The new Great Depression. And Jim would be right. They're very much correct in that respect. But that's the way I'm seeing this pan out at the moment, John, that we are experiencing the new Roaring Twenties. And I just want to give a bit of and this is, I mean, it just seems euphoria at the moment here in Australia. I'm not sure if it's the same all the way around the world, but I just wanted to bring this to our viewers' attention. Well, we're talking about a housing boom at the moment, a potential housing boom that could increase at the rate of 10%, prices going up 10% a year for the next 3-4 years. Everyone I know at the moment is buying caravans, camper vans and everything. They all want to travel. They do not hesitate in spending $40,000, $50,000 on a camper van. Toys. My neighbour had just purchased not one, but 2 jet skis, one for himself and one for his younger son. And they go out together about once a month. That's what they'll do. They purchased these jet skis about 2 months ago, and they've been out 2 or 3 times. So you get very little usage, splurging money, no hesitation there. Costs are going up. For the first time that I can remember, I spent $130 filling up my car. This was going back about 2 weeks ago. Filled it up again just a few days ago, $130 something. I cannot remember ever spending over $100 to fill up my tank.
You got a bigger tank than
Yeah,
mine,
well,
but I must say, John, the last time I filled up was $100, and actually I kept the pump from stop pumping anymore because I didn't want to spend any more than $100. So it's creeping up very easily. Yeah.
They're also talking food at the moment here in Australia. We are expecting 30% increases over the next few months. Now, this is the cost of living in reality is going through the roof. But there seems to be all this euphoria at the same time, John, like live life now to the max because who cares about tomorrow? So I'm seeing this as I said before, I'm seeing this as the new Roaring Twenties. You reading it the same way, John?
I probably would say, so I would have a slightly different interpretation. So the Roaring Twenties had relatively low unemployment in the US, and then we had relatively low unemployment in Australia as well in the 1920s. Under stagflation, we will see elevated levels of unemployment. And so we had obviously a massive spike in unemployment last year, but not only unemployment, we had underemployment. So people were able to find some work, but not enough hours. And then there were some people who felt discouraged, so they left the labor force, and the participation rate that also fell down. So you are correct that there's a lot of money being splurged around. A lot of Australians are now getting into debt. A couple of points to make on that. The first one is that when I speak to people like Martin Orr from Digital Finance Analytics and a few other people, is particularly when it comes to mortgages, Australians, when they're making this decision of do they sign a high 6-figure, 7-figure mortgage, they are looking at, they're asking themselves the question, can I afford the mortgage repayment today? So they're not actually asking themselves, can I pay back the debt? And they're not asking themselves, can I pay the debt if my circumstances change, which is I lose my job, my income goes down, I get an unexpected bill, or interest rates go up. They just ask themselves, can I pay the cash flow obligation today? And that's a very risky proposition for a lot of people to be in. I mean, like, I don't have a mortgage now, but when I did have a mortgage, I had a very considered sort of mental calculation as to, well, if my circumstances were to change, what does that mean with my obligation to the bank? Because obviously defaulting on a mortgage was the sort of one of the worst nightmares to my mind. But a lot of people are not thinking like that. So I do think that with these low interest rates, with the media propaganda. And the unfortunate thing about Australians is they are so tied to the TV that when you listen to the news day after day after day, and it's like everything's now going to be better again. We have the vaccine, the economy is going to open up, everything's back to normal, and it's going to be better than it was in 2020. A lot of Australians buy that story, and then they think, well, I can go out and take a big mortgage and or take on debt to splurge on various things like jet skis and camper vans and caravans, etc., because the government says everything's going to be okay. But that's obviously too short term, and people are not considering the risk. So that's point one. The other point I will make is that I do think so. We're speaking now, Darryl Bryan, in March. I do think April is going to be a very interesting month going forward. So we know that in 2 weeks, Job Seeker and Job Keeper will come to an end. Now, there are some estimates that by ending these stimulus programs, it could impact up to 1.5 million Australians. That could have huge flow-on effects right across the country. And it could well be that while we've had a few months of euphoric borrowing and splurging by Australians, but also factoring in the Christmas period, we could start to see a dramatic pullback in consumption starting April because of Keep a Job Seeker ending, and that could then lead to persistent unemployment problems going forward. So I don't think we're out of the woods. I think we're going to have further issues with unemployment going forward. But in terms of the roaring 20s, so people are living carefree. People are not considering risk. Government's not considering risk, and that's why we've got these record deficits and unprecedented amounts of monetary stimulus. And that's why I do think that what I started saying in mid-2020, that we've got stagflation, I do think that's true. And one of the key messages I think I said in my last interview with you guys last month was, with the Biden administration, I think we're going to have accelerated stagflation, which is this process of stagflation, which is low growth, relatively high unemployment and rising prices. I think that's going to get faster because of the Biden policy package. And we're starting to see it right around the world. So whether you look at, so I know you were talking about some consumption goods, Darryl, but if you look at copper, if you look at oil, if you look at grain, cotton, freight costs, share markets, I mean, you clearly see inflation all over the place, and yet we still see this narrative by governments and central banks that inflation is subdued. The evidence is just so contrary to what the government and the central banks are saying.
Yes, and what we have learned, John, is that confidence is a very fickle thing. 1 minute you can be super confident and it can all be taken away from you in moments. And I mentioned this to Jim the other week, and I'd like your response on this too, John. President de Gaulle, 1965, made an announcement, and you can still Google it, I believe, but he said, I do not trust the Americans, do not trust their currency, I only trust gold. Sent a warship to the United States of America. This was just during the Vietnam War. Sent a warship to the United States of America with a bunch of US dollars on board and exchanged it for gold. Numerous other countries decided to do the same thing after that. President Nixon that is, knew that if he provided all of the gold at those countries' requests, he'd run out of gold because they'd overprinted to support the Vietnam War. That, of course, led to Nixon taking America off the gold standard in 1971, and all hell broke loose. From 1972 through to 1980, gold went up 24 times, silver went up 46 times, just through a sheer lack of confidence in the economy. Was it back with gold? Well, it wasn't after 1971, so all the questions were asked. Confidence is very fickle, and which can lead to massive crashes, and people then start searching for commodities and or investments that represent real worth. How say you?
I mean, in terms of the history, you got the history absolutely correct. In terms of confidence being fickle, I mean, for example, so the markets were sort of moving in the inflation direction over the last few months, but it was still done in a relatively orderly and calm way. And then all of a sudden, in the last 2.5 weeks, panic is the bond market starting to panic, and people are worried about whether the American government can continue to finance these deficits. People are worried about interest rates. People are worried about the real rate of return. People are worried about deflation if these bonds don't, if this bond market doesn't get under control. So yeah, so I agree with you absolutely. And I have to say, relative to say the 1970s or even the 1920s, given that we have electronic markets that are globally connected and we have fast ways to communicate, bad news spreads faster. People can make financial decisions faster in terms of buying or selling assets, and these financial markets can move, particularly with high frequency trading and all these algorithms. These markets can move much faster and much more rapid fashion than in previous decades gone by. So so everyone's fickle. Everyone is can change their point of view and their asset allocation on one bad announcement. And so obviously that's why I think it's important that people continue to do their own research, continue to on the one hand listen to what governments and central banks are telling them, as well as the mainstream financial press, but also looking at the underlying statistics, the research in terms of the foundations of the economy, and think to themselves, is what I'm being told consistent with the facts, or are the facts saying that something is different? And then if people find that the facts are different compared to what they're being told, like I do, people then should allocate their capital or their financial portfolio consistent with what they believe the facts are telling them.
Incredible. John, I have a question. This is mainly referring to the combination of stimulus packages and how it affects the bond market. Before I ask the question, though, or make the statement, I was reading an article yesterday, and obviously we've heard that the United States is now going to implement a 1.9 trillion. We've talked about this, 1.9 trillion. We got trillions here, not billions, but trillions. But 10 years ago, I'd never heard of the word trillion, never used. But 1.9 trillion. So what it worked out to, America has a population of around 330 million people, including obviously husbands, wives, and children. There's going to be 100 million families in the United States that will receive $7,000 per family. 7,000. I mean, this is like paper money, monopoly money, the way I see it. And by the way, if you're on a combination of husband and wife income per family of 150,000 is the average over there, right? 150 of the 100 million, they're earning 150,000 combined package, you will receive $7,000. So my question, if the US government has just passed this 1.9 trillion COVID-19 relief stimulus bill, and they're on track to deliver a budget deficit, US 4.7 trillion for the current financial year, what are the implications for the US bond market in the coming 6 months?
The big question for the bond market, Brian, is where they're going to come up with the money. I mean, so when we look at the financial year 1920, which was the last financial year for Trump, and I should say that the financial year for America works slightly differently for Australia. So we go from July to June, whereas Americans go from October through to September. So from October 2019 through to September 2020, Trump incurred a $3.3 trillion deficit. Now, they were on track to do a smaller deficit of $2.3 trillion for 2021. Now they've just passed $1.9 trillion in the stimulus on top of the $2.3 trillion. And then you added in $0.5 trillion on this climate change package, which they still haven't passed, but they're planning to bring in, which is $2 trillion over 4 years, which means it's $0.5 trillion this financial year. And then you can put that on top of existing government debt at about $27 to $28 trillion. And you think to yourself, well, where are they going to come up with the money? So the Americans are in an absolutely no-win situation. If interest rates go up, if these bonds continue to sell off, the American government can't finance the existing debt, let alone these new deficits. But on the other hand, if they continue to go with these deficits, so here's the thing: they have to keep on rolling over all this existing debt and find new people to buy it and to continue to hold all this debt. But if you add an extra 4.7 trillion to the mix in just one calendar year, there's a real big question as to particularly what happened on the 25th of February when the foreigners basically said we're no longer interested in buying your debt. Well, the Americans are going to be in a really tough pickle, and that's why the expectation of the market and in Wall Street is that the central bank are going to increase their balance sheet. So if we think about they did QE, and they took their balance sheet from 800 billion to 4.5 trillion up until I think 2014-15. Then they started doing quantitative tightening, shrinking the balance sheet to 3.8 trillion by August of 2019. Now we're at 7.5 trillion. And it could well be that the only way to keep financing these deficits is to increase quantitative easing. And Janet Yellen, who was the former chairman of the Federal Reserve, who's now the Treasury Secretary, is on the record of saying if there was ever a time to go big, now is the time. And you scratch your head thinking, well, haven't you gone big already? I mean, how big can you go? So she's now saying it's now time to go even bigger. Well, the balance sheet could easily explode to 10 to 15 to 20 trillion dollars, and that's obviously where, for example, Jim Rickard comes up with these forecasts of 10,000 gold, 15,000 gold, 20,000 gold, even Jim Rogers is saying that within 2 or 3 years we may even see 50,000 gold because of the scale of the printing. So the only way that the bond market survives with all this with this additional $4.7 trillion of new deficit is that they just have to hyperinflate the balance sheet, and the central bank has to print everything up. And then obviously there's a question about what happens with inflation, both in terms of real terms, but also what the government is willing to acknowledge and how investors respond. Dare I say that Biden and his team are scaring the market. That's why we've seen concern and turmoil in the bond market already. And I think with these deficits and the poor policies that Biden is implementing, that concern is going to continue through over the next 6 to 12 months, and not only 6 to 12 months, but also beyond. I mean, the key point that has to be made is, whether you agreed with Trump's policies or not, one thing that he was able to do relatively successfully is boost the confidence of American investors. So American investors really bought the Trump narrative of he was going to bring America back, he was going to improve the economy, he was going to return manufacturing and restructure the economy and boost corporate earnings with tax cuts and regulatory relief, etc. So a lot of people, confidence among investors as well as consumers went up quite high after Obama because people bought into the Trump narrative. And yet you look at confidence now, I think Biden's driving confidence down through the floor. And that's definitely going to have an impact on not just sentiment, it's going to have an impact on where people put their money. And it's going to be a very dicey situation for the Americans going forward with these current policies.
If these current policies continue, John, this is what we're going to end up with. All right, this is what we're going to end up with. I want everyone to see this. What am I holding? Deutschmark. I'm holding Zimbabwe currency. But in the end, mate, it's worth nothing. Confetti, my friend. Here's what, and people laugh at this and say, oh, it would never ever happen to us. This is a $100 trillion note, a Zimbabwean note, 2008, not all that long ago. Value of that currency at the time, Aussie, $1.20. $100 trillion, John. You could see this just being swept up in the street. It was just going down the drains. People were just throwing it away. It just had no value at all. This can be where we're heading. People need to understand this. What everyone fails, or a lot of people fail to understand, is our currencies today are backed by nothing. Zero. They're backed by the US dollar, which is backed by nothing. See, there was a time where we used to have these things, silver certificates. That's a US $1 note. It's a silver certificate. If you have a look at a US dollar today, it doesn't have that on it. You could have taken this to a bank pre-1965 in the United States of America, and you could redeem this for currency, $1.20, you could exchange. Right? So this had a solid backing, gold and silver. Silver backed this note. Today, no such thing. And so that's the track we're heading down, and it always catches people by surprise.
Yeah. I mean, while you were talking, John, I can only think that maybe if I was an American, I might be looking at going into business in the printing industry. And the reason why I say that, because it's the only thing I can see expanding over there, is that the money printing is with that the US Federal Reserve will require more printers to print the trillions that have to be done. And that's all there is to it. Yeah. Right. I have no confidence in the US dollar. Therefore I have no confidence in the Australian dollar, because they are backed by zero.
You're sounding like President de Gaulle.
Well, you can print as much as you like, but what is the value? We always got to have a look at what is the value. Darryl?
Yes, some very, very difficult times ahead, and a shock for a lot of Australians, I'm sure. John, the US Federal Reserve will be meeting on the 16th, 17th of March. And the market is anticipating additional money and monetary stimulus. I know we've spoken about this, but especially around yield curve control. Can you explain the difference between yield curve control and quantitative easing?
Quantitative easing is where a central bank prints money out of nothing and will just go buy a set amount of bonds. So, for example, the US Federal Reserve at the moment is buying about $120 billion worth of bonds per month, and they'll buy them at any price in the market. Now, yield curve control, and like I said in one of my previous answers, as a yield curve control has been implemented in Australia. We have it at the moment on 3-year bonds at 0.1%. Basically, you commit an interest rate at a particular target, and you then buy as many bonds as required to keep that target. So that's why last week the RBA, in the Australian context, said they were going to increase their bond buying program from $2 billion a day to $4 billion a day, because at $2 billion a day they weren't able to keep that interest rate at 0.1. So if next week, so the market is expecting, because these interest rates continue to go up. Now, in the last 24 hours, I should know that we've had a bit of a rally in bonds. So the bond yields have sort of come down slightly, but these bonds are still elevated. So the US 10-year bond yield is at 1.53, and last week, but also on the 25th of February, it got up to like 1.6. So if they come out and say, well, we're going to cap, for example, 10-year bonds at 1.5%, that basically means is that in order to have credibility in the marketplace, no matter what happens with the bond market, they just have to keep on buying to keep that interest rate at 1.5%. So if it means that they've got to print, rather than $120 billion or buy $120 billion a month, they've got to buy $200 billion a month or $500 billion a month, whatever the case may be. That's what they've got to commit to, and that's what the market is. That's what the market is expecting coming out of America. Now, Japan has yield curve control, and they've had it on 10-year bonds since early 2016. Australia has it. Some of the other countries around the world has it. Now, for some of our audience who are not aware, the Americans did do yield curve control during the 1940s in the Second World War. So, in order to finance the huge deficits to fight the two wars against Japan and Germany, they did basically cap the bonds at very low interest rates. They printed exorbitant sums of money, not as big as what we are talking today, but for the times, it was an extraordinary sum of money. They bought these bonds to basically finance all of the expenditure on the military, but that then led to quite a bit of high inflation in the 1940s, and you did see a rally in gold and silver, increased demand, and particularly around gold and silver mining stocks. They went through the roof during the 1940s. So now, after the Second World War, they stopped yield curve control, and the government effectively bought back all these bonds that the US Federal Reserve purchased. So during the 1950s and the early 1960s, the American government under Eisenhower and then Kennedy ran a range of surpluses, and with those surpluses, they bought back the bonds and shrunk the balance sheet. So that's how they've done it. But anytime we've had whether it's QE or yield curve control, it does cause inflation, and that is what I'm expecting to happen. Now, I just want to make a point about what both of you were saying previously. It's a very interesting observation about $100 trillion note coming from Zimbabwe. So I was at a party last weekend. For my daughter had a birthday party she went to, and the person who so it was another girls' party, and I was talking to her father. Her father's background is from Lebanon, and he's very keen on the markets. And we started talking about hyperinflation. So in 2019, Lebanon had the third or second highest level of public sector debt relative to GDP in the world. And what happened in 2020 was that the bond market imploded in Lebanon. And basically, the Lebanese pound went through the floor. And now you see hyperinflation in Beirut. So when we're talking about the bond market crisis, and I talked about the risk of runaway inflation, hyperinflation, just like you were holding up those notes, Darryl. So he kept on saying to me, but America's different. America is so powerful, it's so big, that it can withstand some of these bond market pressures. And then I said to him, well, have a look at your sort of heritage. Look at Lebanon. Lebanon has hyperinflation today. And if anyone wants to, if we have any viewers with Lebanese heritage, or if people are interested, just go on YouTube or Google and just look up the value of the Lebanese pound and how ordinary people in Beirut are struggling to get the basics like bread. So hyperinflation is happening. Now, it's interesting that when I laid out this example, the retort was, well, Lebanon's only a small country. America is a completely different sort of proposition. But again, the main thing is you go back to the fundamentals, which is when you print something out of nothing, ultimately that currency is going to collapse. That principle has held for 1,000 years. The first paper recorded in human history of paper money was in China. They printed too much of this paper money and led to hyperinflation, and that form of paper money collapsed in China 1,000 years ago. And every time that we've tried this experiment, they always collapse. So I would just say to our audience, if you think that America is so big and powerful that they can withstand economic history, dare I say that people are going to be in for a rude awakening.
I think they will be too, John. It's really interesting. As I mentioned, President de Gaulle just a short while ago, he lost confidence in the United States and the American dollar. Prior to that, who would have thought that Great Britain would have lost their ascendancy? Prior to World War I, they were the most dominant country in the world. But when America provided goods and services to Great Britain, they paid for those goods and services, or Great Britain did, in gold. America wasn't prepared to take their currency, the British pound. So, once again, it can happen to anyone, can happen to the most powerful nation in the world. And if you go back through history, and this is the problem with most people, they don't study history, and they don't realise, or they forget that great countries and empires, and you can go back 5,000 years to, of course, the Egyptian Empire and the Roman Empire. Who would have ever thought that they would fail? And who would have thought, as I said, Great Britain? And prior to Great Britain, it would have been the French. And prior to the French, it would have been the Dutch. No one would have ever thought they would fail, but they all have, because they've all made the same mistakes. Exactly the same mistake that the US is making right now.
Yes, again, I was thinking every one of these empires is averaging about 100 years, and you look at the United States took over from Great Britain in around the 1920s, just after the First World War. Britain was absolutely broke, and the United States had plenty of gold. So, the US dollar became the next big empire as a country. But now it's 100 years past. It's now 2020. 2021.
Time for a change of the baton.
Time for the change of the baton. John, one of the things that's really got had got my blood boiling. It has for the last couple of years, and the respect that the statement always gets made, even by good economists, that we have no inflation. We've talked about inflation today a little bit, but I want to get back to what the description of the word inflation was, let's say from the 1980s, and this description of the word inflation in the
right
now. Now, this is a word, it's an English word, inflation. What did it mean though in 1980? How do they discover inflation as against today? All I can say, and I want your comments, John, all I can say is that you can have inflation, but what's the description? I know today that food and energy is not in the basket of goods to measure inflation. Well, nobody can live without food and energy. So the question is, I'm going to put a question here right now. One of the key economic debates which is occurring at the moment is whether the global economy is experiencing rising inflation. Or, block of land. Can you explain what is inflation to our audience, and what indicators can we cite that demonstrates rising inflation?
I think we just need to take the audience back to before John Maynard Keynes and his famous book in 1936. So the classical economists, if you picked up an old dictionary from the 19th century or the early 20th century, the definition of an inflation is to inflate in terms of the money supply. So the money supply is getting bigger, and that is the quantity of money inside the economy. Now, the consequences of increasing the money supply is rising prices. So now, after John Maynard Keynes came out with his book and we had the whole Keynesian revolution inside the economics profession, the definition changed from rising or increasing money supply to rising prices. And then you started to get governments trying to measure prices, and we come up with things like the consumer price index or the producer price index and a whole bunch of other price indices, which is trying to measure what is the rise of price. And so So the classical definition that I tend to focus on is, let's look at the money supply, because when you print money and the money supply increases, that money has to go somewhere. Sometimes it goes into financial assets, sometimes it goes into real assets like commodities or land, and then obviously sometimes it goes into sort of ordinary goods, ordinary consumer goods and services. So I think the key thing for our audience is look at the money supply and what's happening now. There are different definitions of what the money supply is. You've got M0, which is basically physical. You've got M1, which is cash and deposits. You've got M3 in the Australian context, and then you've got broad money. So, those definitions and those different measurements of money should be examined by our audience, and a lot of documentation on the internet about those various measurements of the money supply. But the other key point is that so in the 1980s, inflation was at that time considered rising prices. But what happened was, in the last 3 decades, governments have manipulated their measurement of their price indices to hide the level of inflation. So from the 1980s to now, we still focus on the same thing, rising prices, which I still think is the wrong way to look at it. But for example, in 1998, when John Howard first came into government, one of the first things that his government did through the Australian Bureau of Statistics on the recommendation of the Reserve Bank of Australia, which is to take land out of the CPI. So we have a property bubble in this country driven largely by rising land prices. And those land prices are not captured in the CPI because it was taken out in 1998. So had land been still in the CPI, inflation in the last 2 decades would have been much higher than we recorded. And the interest rates, because we have this inflation targeting regime, interest rates in this country would have been higher on average, and that would have meant that people would have they would have borrowed less and saved more. So the key thing is, and I've spoken, having worked in federal parliament before and having continual discussions with federal politicians, I have suggested from time to time that the parliament should look at whether the CPI, the Consumer Price Index in Australia, whether that actually measures inflation accurately or not. Because one of the paradoxes of working in federal parliament back in 2012-13 was the government, the government and the parliament at that time kept on saying that inflation was low, and yet all of our political research in the Liberal Party was that the cost of living was the number one economic issue. So both can't be right. You can't have the establishment and the parliament and the media say inflation is low, and yet the people are saying to the parliament, no, our biggest issue is prices. So one of those stories is correct, and obviously I would agree that the rising inflation narrative that is the correct story. Now, in the last few months, how can we point to evidence that inflation is getting out of control? So we can look at the prices of commodities. So you look at the price of oil, cotton, grain, in terms of freight costs, lumber. You look at zinc, etc. You are seeing right across the board prices going up quite aggressively for raw commodities, and that typically means that A, there is inflation, and B, that those raw commodities take time to flow through to the economy. So we will start to see the producer price index. So producers will be registering higher prices, and those prices will be passed on to consumers. But that typically does take some time. Now, one of the key points that central banks have been trying to suggest that we have low inflation is they look at wages. So typically when you have a higher inflation environment, wages tend to go up quite aggressively because people try to keep their nominal wages consistent with the rise in terms of price, in terms of rising prices. So we haven't seen wages go up aggressively, particularly because we still have elevated unemployment. But I do think that commodity prices going very, very high very quickly is going to flow through to the real economy, and that I think is one of the key things that the bond market is looking at. Well, these rising commodity prices, which in some cases have gone up 200, 300, 400% in the last 6 months. I mean, that's clearly, if the price of cotton's gone up 200, 300% in 6 months, that obviously is going to mean that cotton shirts and other products that use cotton are going to be more expensive, once that raw material flows through the supply chain.
Well, everything you said is very valid points, John, and I honestly think that we're not being told the truth. Some time ago, I was thinking about joining politics, and I thought to myself, I don't think I'd ever make it because I like telling the truth to the people, and if you're telling the truth to the people, I think you're going to be shot down. So maybe the days of being a politician is not so good at all.
Darryl? John, I spoke at a convention on the weekend and spoke obviously about precious metals. And I mentioned the silver squeeze, and to my absolute shock and surprise, when I asked a question who knew what I was referring to, there were only 3 or 4 hands that went up in the room, around about 60 people. Surprise. Maybe I shouldn't have been. But there has been a lot of chatter about the silver squeeze over the past 6 weeks. And you've written a couple of significant articles about this, both registered on our website and on yours, adamseconomics.com. And in particular now is of huge interest because we're in the March delivery month. So can you provide an update to our audience on the latest on this silver squeeze, what we may be able to expect moving forward?
My experience, working with As Good as Gold is when a lot of our clients or potential clients come into the gold and silver market, obviously they're looking at the price and what the price behavior is there, but a lot of people don't understand how the price is set. And the price is set in New York through a commodities futures market called the COMEX. So now so when it comes to, for example, the silver market, March, May, July, September, December is when these contracts typically come due for when people have to deliver silver. And so we are halfway through the delivery month, given that we're in March 2021. And so the silver squeeze started at the beginning of February. So we had the GameStop phenomenon, and then people started to promote to say that, hey, we've got a a short squeeze opportunity in silver, because the price is well below what it actually is, and this is because of the amount of naked shorts that are on the COMEX. So we're the only precious metal dealership in the country that talks openly about market manipulation that a number of our overseas colleagues and guests talk about, and so that market manipulation is what people were referring to as the opportunity. Now, we saw, particularly in North America, but we also saw it in some of the Asian and European markets as well, there was a scramble for silver because that was the chant and the call that if everyone bought physical silver, we can basically bleed this COMEX market dry, and they won't have enough silver to meet all the record deliveries that they're being called to deliver in March. And so what we saw was huge amounts of demand for retail product. North American bullion dealers got cleaned out within a few weeks. We saw stress in the wholesale market. So even Rick Rule, who runs the PSLV, the Sprott ETF, basically did 2 interviews last week and said that in January there was plenty of 1,000-ounce good delivery bars floating around North America. Now it's extremely hard to find them. We also saw in terms of the SLV, the largest silver ETF, they, in very controversial fashion, had to change their legal documentation. So basically, once people put money into the trust, they are legally obligated to put silver into their vault that's commensurate with the amount of new money that's come in. They changed their legal documentation to say that given the lack of availability of silver, there may be a mismatch between the number of shares on issue and the number of the amount of silver in the vault. So we've clearly saw over the last 6 weeks enormous stress in the silver market in terms of being able to get physical silver. Now, as we are in halfway through March, so as we speak, about 46.5 million ounces have been asked for delivery. And so far, from what I can tell, looking at the delivery warehouse data, only about 8 million ounces have been delivered. So they have the rest of the month to come up with the rest of the silver, and yet there'll be more delivery requests for silver between now and the end of the month. So what we are seeing is we're seeing this silver squeeze continuing to happen, because physical silver, in particularly investment form, these 1,000-ounce bars, they're getting much harder to get. There are more and more requests for delivery. And at some point, if the people who are required to deliver the silver, which are mainly Wall Street banks, if they run out of enough silver to deliver consistent with their contractual obligations, that's when we're going to start to see the price go quite high. And that's what actually happened in July of 2020. So the first 2 weeks of the month, the price really didn't do anything, or it was floating around I think $17.90 US an ounce. And then by mid-July, for 3 weeks, the price went up 60%, all the way up to $29 an ounce, because they ran out of silver. And with this futures market, when you run out of silver and you need to attract silver to meet your delivery requirements, you need to let the price go higher so that you can entice people to sell. And that's why the price went through the roof 60% in 3 weeks last year. And it could well be that as we go through the next couple of weeks, we may start to see the price escalate quite high, because they may be short on getting enough silver to deliver consistent with these contractual obligations. But if they can come up with enough silver without the price going ballistic in the next few weeks, well, then we turn our attention to May, and the open interest, the amount of silver that's that may be requested in May, which is the next delivery month, is going to be again quite strong. And I think that the demand for physical gold and silver is going to increase after next week, after the US Federal Reserve makes some sort of announcement about additional stimulus, and that's going to apply more physical pressure on these COMEX exchanges, and that's where I think we're going to start to see prices go through the roof quite aggressively. So that's what I've documented in my 2 articles over the last 2 weeks, and so I continue to buy silver and silver mining shares. I think the environment, the macro picture, as well as the macroeconomic picture, which we've been largely discussing in this article, is very bullish for precious metals. And then once we start to look at the physical market and what's been happening, particularly in silver over the last 5 or 6 weeks, again, it's very bullish for silver. And I think this process, which I've documented in the articles, are going to play out, over the next few weeks, but also over the next few months. And for those investors who were able to buy in early into this bull market, I think it's going to be happy days in the next few months.
Yes, I know that Ed Steer, who we hold in high regard, of course, was quoted as saying just recently that if the COMEX breaks, then we could see, we're not talking about silver going up at $1 overnight, as I mentioned earlier in this interview, but we're talking it could go up hundreds of dollars an ounce in the blink of an eyelid. That's the dramatic effect that a real break in the COMEX could have as impacting on silver prices. So, and at the moment, it appears as though we're in for a rough ride. That could quite possibly be the case.
What the public really, our clients, the public really need to know is that the silver to gold ratio, which is how many ounces of silver to buy an ounce of gold, presently in the mid 60s, 65 to 1, 66 to 1. But silver coming out of the ground, if you speak to Keith Neumeyer,
Yep.
he says with all the silver mining companies around the world, they're averaging around 8.5.
Yep.
8.5, and its value is 66. Something is going to break.
Yeah.
Something will definitely break.
Yeah, well, we know in the United States it's almost impossible to access silver at the moment. We know the bullion dealerships over there, and we connect with them, and we know what their position is. We're a little luckier at the moment here in Australia, but hey, it doesn't need a lot more pressure on the COMEX to see this thing absolutely change direction, and you just won't be able to buy it. You will not be able to buy it.
And by the way, silver mining is a very hard business, and the average silver mine worldwide takes somewhere between, by the time they discover the silver, it takes between 10 to 13 years to get that silver out of the ground. So it's not something you can fix up in the first 6 months, 12 months.
Yeah, I think the other thing is, Brian, that's correct. But Keith Neumeyer was saying, I mean, they employed something like 3,800 people at First Majestic, and at one stage had to put off about 1,600 people. This is going back a couple of years ago.
Yeah.
But to replace those people, if you let people off, and then you have to replace them because there's a new surge in the metal, finding those replacements is impossible overnight. You just can't do it.
Yeah.
It takes time.
Yeah.
So they can't dig it out the ground anywhere near quick enough to supply the demand at the time. So we can see huge ramifications coming up.
Yes, it certainly is. Look, to finalise, there's one question I've got. It's not really a question, but it's the statement that we've got to reward John Adams now, as good as God's going to reward John Adams. Because, John, you can speak about this in a few seconds after I've given the news. But GARTA is a company in the United States, and the GARTA stands for Gold Antitrust Action Committee. It's run by two gentlemen, Bill Murphy and Chris Powell. What's happened in the last 3 months or so is that John's articles, economic articles, which he produces on his own website and on ours, right, have been going over to GARTA. GARTA's picked them up, and they're sending those articles out to different identities in the United States and endorsing them. So, John, tell me about what's happening.
Because I've been doing a lot of heavy research in the silver market, I've been in touch with a number of our international colleagues, both in the US as well as Canada and the UK. And so I've got a very good relationship with Bill Murphy and Chris Powell. And Chris has enjoyed some of my analysis, and I've written a couple of articles in the last month about the silver squeeze and the pressure on the fiscal market, as well as my latest article was about how this bond market crisis was going to lead to a break in this a break in the price ceiling that we're seeing now. So because effectively silver is struggling to get above $30 an ounce, and so we've got effectively a price ceiling because of the way the COMEX actually works. And so the article goes into some detail as to why do I think the price is going to get above $30 an ounce, and how this bond market plays into that story. So they've enjoyed my analysis. They've felt comfortable to endorse it and to send it around to their global network, and that's resulted in a lot of attention to my website and some of my articles. And yeah, so I mean, like I said before, we're the only bullion dealership in Australia that openly talks about market manipulation. We're the only ones that actually interview GATA, and also a whole bunch of other people in the industry who are open and who are openly willing to acknowledge the corruption and the manipulation in the market. And so, given that they are the leading organization in the world, and they've been trying to reveal the true dynamics of this market manipulation for two decades, the fact that they were willing to endorse my analysis and send it to their network, I mean, that was high praise, because obviously if it's not good, they're not going to send it out. And so I thought it was a big sort of honor, and I'm glad that people around the world have come to my website to read some of my stuff. And if people haven't had the opportunity to come and read my material, I would welcome it either on the As Good as Gold website or my personal website. And yeah, like the more that people do their own research and try to figure out what's going on, the better you can make financial decisions and also understand how these markets work in real time.
It's great to see John has become such a dominant figure on a global scale now.
Absolutely.
Yep.
Reminds me, I think it was the second president of the United States was named John Adams, so maybe we might see another presidential prime ministership here, John Adams.
Yeah. Nothing beyond this man, no. I don't think.
No, not at all.
John, look, before we go, I would like to make reference to a couple of quotes from a couple of men that Brian and myself and yourself have got to know very well, of course. But Egon von Greyerz, I don't think there's a better time to quote his comment at the moment. He has many of them, of course, but Egon's constantly referred to when asked the question, how much should I invest in precious metals? He says, whatever you can't afford to lose. And right now, I think he's right on the button. My great mentor, Peter Daniels, I'll never forget, Peter used to say, and still does today, of course, but I do not care what poorly executed economic decisions are made in the world tonight. Tomorrow, I will still be able to party, because he holds sound money. Gold, silver will get him through any dilemma, any major downturn. He'll stand firm. And Jim Sinclair, of course, become your own central bank. If central banks own precious, I mean, I'm not a great supporter of the central bank system, but and their attitude to money. But if it's good enough for them to own gold, you've got to ask yourself, why do they own gold? They own gold to support the currency of that country. In the case of dilemma, gold would be their first source. So if that's the case with the central bank, why would it not be for you? Why would you not want control, power, influence in times of economic turmoil? Of course you would. Gold and silver, the safe haven investment, they have always provided that.
Absolutely.
So at that, I think, once again, we thank you, John, for your input. Your research is fantastic. You're being recognised not just by local viewers now, but all around the world for your input, the work you do. Very much appreciative. It's great to have you on board, and we look forward to having that experience with you for many years to come. For our viewers and our subscribers, we'd like to thank you so much for your support. Without you, of course, we wouldn't have a channel. And so thank you once again. Until next time, stay well, stay focused, and goodbye for now.
Goodbye for now.